Hello everyone, my name is Thomas Biegler and I am alongside my partner Jacob Kello, and today we'll be pitching Algonquin Power and Utilities Corp, ticker AQN, to be added to the AIM International Fund. When searching for a stock to add to our AIM International Fund, I wanted to find a utilities company that operated in the renewable energy space in order to capitalize on the rising demand there. Additionally, under the current very unstable climate due to COVID-19, I wanted to find something that would provide a little more stability. When finding a stock that met these criteria, we came across Algonquin Power and Utilities Corp, ticker AQN, which is a diversified utilities company that operates in both the regulated and unregulated energy markets. Today, electric utilities account for 48.27% of annual revenue, and is in fact this number that management has been focusing on to increase along rising market demand. Additionally, as of today, the United States accounts for 94.6% of Algonquin's revenue, with the remaining 5.4% in Canada. However, in order to further increase their diversification to minimize risk exposure, they're actively increasing this exposure in Canada. Finally, Algonquin was founded in 1988 and is headquartered in Oakville, Canada. So what makes Algonquin special versus all of the other boring utilities companies that you don't want to read about? Well, in fact, in April 2019, the renewable energy consumption in the United States surpassed that of coal, signifying a legitimate trend that is moving away from traditional fossil fuels that hurt the environment to green renewable energy. To meet this trend, Algonquin recognized years ago that they need to get away from these traditional energy sources and move towards the renewable space, and that is why they brought on Arun Vanskuta, Algonquin's new CEO, who is moving away from natural gas and coal and towards solar and wind. In fact, just last year, Algonquin was able to add 1.6 gigawatts of installed capacity to their portfolio, and when construction is complete in fiscal year 2023, this will represent a 12.5% forward 4-year CAGR. On top of this increasing top-line growth, Algonquin is also experiencing minimizing costs as solar energy has decreased 37% over the last 3 years, and wind energy has decreased 13% over the same time period. Together, these two factors are creating gross margins over 25% that are still growing today. Therefore, it is recommended that Algonquin Power and Utilities Corp be added to the AIM International Fund at a price target of $23.38. Moving on to our drivers, the first is a general increase in market share due to a shift in energy preferences. In 2019, U.S. renewable energy consumption increased over 6%, and this number is expected to rise in the coming years. To meet this trend, Algonquin added an additional 1.6 gigawatts of capacity to their already impressive portfolio of 2 gigawatts, representing a 28.5% capacity growth. In addition to growing their overall portfolio, management has also focused on expanding their solar portfolio. Due to the recent 5-year extension of investment tax credits, which is a 26% tax incentive credit used to incentivize utilities companies to produce solar energy. With the wind portion of this ITC expiring this year, solar is going to become increasingly attractive, and with the cost to produce solar energy already decreasing 24% faster than that of wind, the solar energy section of Algonquin's portfolio is going to create margins higher than have ever been seen. Finally, in addition to experiencing lower input costs, Algonquin is working on minimizing their overcosts by creating joint ventures and other partnerships with utilities companies. Since demand in the United States and Canada for renewables is growing so fast, the only way to meet this demand and the increasingly large capital that is required to start new projects, these utility companies have to partner up in order to not take on too much risk in their portfolio. One of these joint ventures is Aegis, which is with the Spanish powerhouse utilities company known as Abengoa, And there's also a variety of other different partnerships that Algonquin is invested with, which is overall minimizing the risk through diversification. In fact, this lower risk has already been seen due to increasing positive sentiment from management within their annual reports.
In order to reach an intrinsic value for Algonquin, a 5-year DCF model was constructed. Using a terminal growth rate of 1.25% and a WACC of 6.73%, an intrinsic value of $26.57 was reached. Additionally, a sensitivity analysis of plus or minus 50 bips on the terminal growth rate and the WACC was constructed, yielding a range of $21.69 to $33.66. Next, a 5-year DDM model was constructed using a terminal growth rate of 1.25% and an expected return of 12.215%, yielding an intrinsic value of $22.90. Additionally, a P/E multiple valuation was calculated using a blended average PE multiple of 24.21x, resulting in an intrinsic value of $23.25. Finally, a P/B multiple valuation was conducted using a blended average PB multiple of 2.59x, resulting in an intrinsic value of $17.13. By weighing these four models, 40, 20, 20, 20, a price target of $23.28 was reached, resulting in a 50.22% potential upside. Algonquin pays a dividend yielding 3.9%. Due to time constraints, I will only be covering two of Algonquin's risks, which are regulation and loss of incentives. For regulation, Algonquin's natural gas sector of the company may be subject to heavy regulation and taxes based on the results of the upcoming United States presidential election. In turn, this would increase expenses and affect profitability for the company. With natural gas making up over 27% of the company's portfolio, regulation remains a risk for the company even as it makes its shift towards renewables. Our next risk is loss of incentives. Historically speaking, the cost of wind has been cheaper than that of the cost of solar. Because of this, Algonquin has many long-term contracts in the onshore wind market. However, the production cost of photovoltaic solar energy generation is rapidly decreasing at 24% faster than that of onshore wind. Because of this, Algonquin's heavy investment in wind infrastructure could prove to be a high opportunity cost for the company. Lastly, for management, Arun Banskota, the new CEO, took over the company in February of 2020. He took over the company in a 5-year transition plan and previously was a VP of Data and Energy at Amazon. Arun has a long history of working in the renewable energy space. If you have any questions, please feel free to reach out to us on the D2L discussion page or feel free to ask us questions during our live Q&A on Friday. Thank you very much.